everybody. I am Jennifer Evans, and I lead Constellation Ventures. What I thought I'd do today is first provide an overview of Constellation Ventures, what we look for in potential investment opportunities, and how we work. Then I thought I'd touch on the various funding sources that you might consider as you begin to raise capital. And then finally, I'll share a few thoughts on fundraising, timing, and considerations. So, Constellation Ventures. We are the venture capital arm of Constellation Brands, a leading beer, wine, and spirits supplier. We make minority investments in high growth, high margin, and high potential brands. And we're really looking for brands in high growth categories that are aligned with consumer trends. We're looking for brands that have unique points of differentiation in their categories, brands that are able to develop a deep emotional connection with their consumers, and brands that have shown strong potential to scale nationally. And we've developed a really strong partnership model. So in addition to capital, we're able to provide our companies with deep subject matter expertise. We've built a team with subject matter experts across brand marketing, trade marketing, sales, consumer and category insights, and distributor strategy. And we're able to leverage all of that expertise to help our companies scale and achieve their growth targets. We've also built out a venture sales force that can focus on selling the ventures portfolio. So that's a bit about Constellation Ventures. Next, we'll turn to funding sources and their various implications. So first up, we have friends and family. Incredibly, over $60 billion is raised from friends and family investors each year. I thought that was insane. The great thing about raising from friends and family is that they may be more willing to invest early on because they know you and believe in you. Friends and family investments can also be structured as gifts, loans, or equity, so there's more flexibility. But depending on who your friends and family are, these rounds tend to be smaller raise amounts. So you likely won't be able to fund your business by friends and family forever. And finally, there may be limited subject matter expertise that your friends and family can provide to help you scale. So next up are banks. You could pursue a small business loan. The good news is that this would be non-dilutive since it's a loan, not equity. The bank would likely have minimal oversight, meaning they wouldn't weigh in on big business decisions or strategy, and they'd be pretty hands-off on a day-to-day basis. That said, they will likely provide limited to no subject matter expertise to help your company scale, and debt can be expensive. Then you have family offices and traditional VC. These can be great sources of capital because you'll often find investors who have a deep interest in your category or brand. Raise amounts tend to be larger. There will very likely be increased oversight with investors wanting to weigh in on big business decisions, but they also likely provide strong business expertise and connections to help your business scale. Finally, you have supplier backed VCs like Constellation Ventures. So supplier backed VCs will also have deep interest in your category and brand. They bring strong subject matter expertise and business connections. Similar to family offices and traditional VCs, there will be more oversight and involvement. And one thing it's important to note is that once you partner with a supplier-backed VC, it will likely limit opportunities of working with other supplier VCs. Finally, there are some additional things to consider when you're raising capital. The first point here is that raising capital when your brand is still quite early stage can be challenging because the earlier you raise, the harder it is to determine valuation. Most VCs take into account discounting cash flow assessments, but they also often value companies applying a multiple to trailing 12 months net sales. If a company is really early stage, their net sales likely aren't at a scale to deliver the valuation founders are hoping for. This means you might have to give up a greater portion of your company the earlier you raise, which means you should be really clear about how much you need to raise to get to the next milestone. If you're fortunate to be in a position where you can raise a lot of capital, I would still advise that you only raise what you need and raise more at a later date when your company's value has hopefully increased. Also, be wary of sky-high valuations. Not only can it hurt your credibility with investors if you throw out a valuation that isn't rooted in reality, but if your company doesn't perform at a level to justify that valuation and you go to raise incremental capital down the road, you and your existing shareholders may be subject to a down round, which nobody wants. The last thought I'll leave you with is to make sure that you really fully understand what potential investors are bringing to the table and that you have a clear understanding of what they expect and require of you. So I hope this has been helpful. I wish you luck as you continue to grow your businesses, and thank you so much.